and welcome to the Unavoidable panel. I love that as a title. So as Mike introduced earlier this morning, my name is Michael Poisson. I'm with Ideal Ratings, and Mike kind of introduced me as an ETF outsider. I probably know the least about ETFs in this entire conference. I'm the ESG guy, so I'm the unavoidable guy these days. But we're not that far away, so if we just take ESG, all right, so we're close, we're getting there. I'm going to treat this like a Maple Leafs playoff game. We're going to block the doors so you guys can't get out. You got to stay for the entire game. Although I represent a research and data company that specializes in ethical investing and ESG, I did write a little book on the topic called The ESG Data Revolution, which is how I met Mike Rice. He claims that he read it during the last Super Bowl. Clearly, he didn't have a team in the game, so he read my entire book during the game. So I have a great panel well representing this topic, people that even know more about ESG than I do. We do have some goals for this session. And the goals are, one way to empty a room is have a panel on ESG. So the goal is, next time around, this session becomes a little bit more popular, and then the next time around it becomes a little bit more popular from there. But we do want to leave you with an understanding of what we feel ESG is and what ESG isn't, because I feel personally it's a very well misunderstood topic. It's not a thing, it's a topic. But I'll let the panel tell you more about that. Also, your exchange-traded funds people, why should this be important to you? And probably more importantly, if you're really not into the ESG way of life, but you are into making money in capitalism, how can you incorporate ESG into what you do every day? And more importantly, how do you do good while doing well, or do well by doing good? So that's kind of the objectives for the day. But to get us started, and I'm going to ask the panelists to introduce themselves, as I send them their first questions. But Lenore is with Calvert Morgan Stanley, and I've asked her to give you kind of a working definition of ESG from her perspective, what it is, what it isn't, to kind of set the tone and the context for the next 40 minutes or so. So, Lenore.
Great, thank you very much for that introduction. Like you, I'm a newbie to the ETF world. Morgan Stanley launched a series of ETFs that are powered by research, so they're ESG, Calvert, so they're ESG focused. So I'm thrilled to be here to talk about ESG and what exactly is ESG, because it's certainly been weaponized into the political climate, if you will. It's quite confusing, the definition of ESG. I think the industry was much easier to understand 40 years ago, when it was largely defined as socially responsible investing, or SRI investing, which is more or less associated with an exclusions-based approach. But if we fast forward to today, we hear ESG and impact investing and responsible investing. And while there are a fair amount of nuances around that, at the end of the day, ESG investing fits within a definition known as responsible investing, which is about integrating environmental, social, and governance factors into investment decisions to better manage risk and to generate sustainable long-term returns. As we were just chatting about, ESG information is material, non-financial information that is increasingly relevant to corporate strength. How well or not they manage ESG capital determines that company's corporate strength and their overall long-term performance. So I think the best way to think about ESG is data. ESG is information. And so the idea with responsible investing is to augment traditional financial analysis with careful scrutiny of how well companies manage their off-balance sheet capital, their environmental, social, and governance capital, to get a complete view of risks and opportunities to pursue trying to maximize returns for clients, and for those who care, to also try to drive change or positive impact on a lot of global and environmental issues and social issues. So much to your point, you can do well while doing good. We definitely view these factors as being very interrelated, interconnected, and certainly not mutually exclusive.
Great, thank you for that. Now I'm going to ask a serious question, because there's lots of negative headlines on the anti-ESG movement, the ESG haters. It's really difficult to hate something as she's just defined it. Is there anybody in this room daring enough to raise their hand to say, I identify as anti-ESG? It's okay. Shucks. Anybody takers? No, because I think it's an important time. I'd like to hear the debates. And that would be of more value to both sides if there's more debate. The more time I spend in this space, I'm trying to socialize the term. I'm an ESG, I'm kind of a moderate ESGer. I don't have, I'm not going to apologize that my book isn't published on recycled paper. That's what it is. But if I can get more people thinking about ESG issues, that's great. And if I'm not, so occupied with green things, that's great too. So moderate ESG, if you want to join me, I'm in the middle somewhere. Anyway, the next question goes to Leah. Now, Leah is new to business, new to ESG, new to the world here, professional world. So my question is, why would anybody want to finish school and then try to pursue a career in ESG and finance? Are you crazy?
Thank you, Michael. My name is Leah. So nice to be here today. I'm with Syntax. Just to give a little bit of background about Syntax, we are a financial data and technology company that are classifying companies more accurately than GICS, RVICs. So really getting down to the product line level of what companies are investing their money in and what are their revenue generating products. Circling back to your question, I'll start with why I started in this field. I grew up in Miami, Florida, and as many of you may be aware or have seen the headlines, that Florida is going underwater. And I have seen firsthand through my own personal experiences of not being able to drive to work because of flooding, not seeing gas at gas stations because of flooding. So there's many examples that I've seen firsthand that really drove me to understand that there needs to be awareness around this problem, around climate change, particularly in Florida, but other states as well as Texas, California, the list goes on. So I think for me it was a no-brainer to go into ESG as a career. And how that has changed overall. So the past 4 years, it's become a little bit more mature in terms of the job market. Now you see every type of company under the sun needing a carbon accountant. You see banks and insurers needing climate scenario modelers. And then you just see general asset managers needing ESG risk analysts. You have to understand the data to digest it, to draw your own conclusions, and then come up with a solution. So it's really all over the place. You have so many avenues to entry, and I think it's a very exciting space for many folks to enter.
No regrets yet?
No regrets.
Cool. Meredith, your official role is dealing with clients and understanding their wants and their needs, their desires. If you could introduce, your role at Citi and talk a little bit about, again, why this group should be interested in this particular topic.
Sure. Hi, everyone. I'm Meredith Champa. I'm the head of ESG for our markets business at Citigroup. So that's our sales and trading business. And that means I'm leading our client engagement with our asset manager clients, hedge fund clients, pension funds, et cetera, and understanding where they are on their sort of ESG journeys, and then bringing that intelligence back to us so we can help skill up in the areas that we think are appropriate, and then hopefully build products and solutions that make sense for our clients. So I firsthand kind of feel the varieties of definitions of ESG. I don't think we have two asset managers or two clients that have the same definition or are doing the same thing. So that can be very challenging, and I think one of the reasons why some of the anti-ESG arguments come about is because you can kind of talk past each other, where one person is kind of defining ESG as corporate ESG, so corporate sustainability. What are companies doing in this space versus ESG investing? Like, what are you doing at a portfolio level, and how are you enacting decisions? Both have some legitimate criticisms, but I think they're also just very different intentions, both trying to increase value for what they're doing. So I think the notion generally that ESG is value destructive or is defined as you're sacrificing returns for some other aims. I don't have a single client who defines it that way. I don't have a single client who is willing to underperform the market. So just kind of level setting, I think that is the state of ESG. It's using additional information that maybe is not traditionally used in a portfolio to outperform. How can you glean from this information the best investment decisions. We've seen the increase in intangible assets in the S&P 500. That's something I think people are well aware of. But how do you actually account for brand equity? How do you account for some of those things? We've seen the correlation between ESG data and that element be quite high. And so that's one tool that you can use to sort of help value some of these companies. But again, it's challenging, and where I'm sort of sympathetic to maybe some of the anti-ESG arguments. One, and I think both sides actually agree on this, is the need for more transparency. We need more transparency in definitions. How are you as a firm defining ESG? How are you using it? I think the earlier example of exclusionary approaches, that certainly was the sort of legacy of this social responsible investment. Not a lot of ESG investors are doing that right now. So really understanding what's eligible in your investment universe to invest in, and then most of ESG is a peer analysis. It's how are you as a company doing versus the other companies in that group in this space. And so I would sort of describe it as saying, okay, fuel efficiency is a metric. It wouldn't make much sense to compare two banks on fuel efficiency, but it might make sense to compare two airline companies on fuel efficiency. So what are those metrics that are not traditionally included in a financial analysis? How do we figure out what's material, and then how do we assess these companies on it? I think that's what investors are really trying to do, doing it in different ways. And I'll sort of pause there, but there are other critiques that are sort of interesting to dig into, which we can get into in a bit.
Can I just add to
Please,
that?
yeah.
I'm really glad you brought up the term material. Materiality is a concept that has really come to bear over the course of the last decade, and it's coming out of the work of a professor by the name of George Serafeim of the Harvard Business School. And there have been a lot of academic studies that have been published in the last 10 years or so that's looked at the relationship between ESG strength and corporate performance. And many of them basically concluded with different methodologies that companies that manage their ESG capital well can enjoy things like a lower cost of capital, a higher return on equity, among other things. But George Serafeim went a step further and said something that's demonstrated something that's quite intuitive, and that is only true if companies actually improve in areas that are actually financially relevant to them. So as an investor who wants to use ESG information to try to maximize returns for clients and drive impact, you have to assess corporate performance in those areas where it's most financially relevant, and that's exactly the point that you were making. So when you're looking at, let's say, retail apparel companies, I think most people would agree that looking at supply chain management, human capital management is critical to corporate strength, because if there's negative headlines, of course, that would potentially cause that company to lose its social license to operate, have a negative impact on their overall brand. A lot of people don't know it takes a lot of water to make clothing. We know this through an engagement we did with Hanes at Calvert, but it takes 20,000 liters of water to make a shirt and a pair of jeans for a single person. So if you're looking at ESG information to uncover risks and opportunities, you're going to want to look at how efficient are they in the use of natural resources. Being more efficient could lead to bottom line savings. Weather patterns are changing around the world. If they're not adequately forecasting for that, that could lead to supply chain disruptions. If that company turns around and depletes the water to the detriment of the surrounding community, there you get involved in negative headline risk. So that's why I was saying at the very beginning that ESG data is information that is increasingly critical to corporate strength and investment outcomes for clients, and that's why we should be paying attention to this. And if I may just take this in a different direction, your question was essentially, why should financial advisors care and be proactive? I think outside of the investment merit approach that we've talked about so far, a lot of investors are interested. The next generation, we've got statistics that show that 99% of millennials care about ESG or responsible investing. So if you're not talking to the next generation, you could be putting your business at risk when the transfer of wealth takes place to the tune of $47 trillion. Women are highly interested. Probably not ironic that we've got a good panel of women here talking on the topic. 64% of women report they feel misunderstood by their current advisor. That's probably because they're not talking to them about what matters to them. And at least around a third of high net worth individuals want to make a difference with their investing capital and are increasingly drawn into this space. So being proactive represents a growth opportunity. It represents a way to protect your business when the transfer of wealth takes place. It differentiates you. When you can talk about engagement stories that have worked to strengthen companies and drive change, it generates organic referral sources. And lastly, it also helps you retain assets during volatile times because people are seeing value in their portfolio beyond just investment performance, which of course will be volatile through market cycles.
Thank you. Michael, you're up next, but before we get there, one observation, and that is, I love this theme of materiality and non-financial data, non-financial information. It makes, and I shared this with a couple of the folks, makes me think back when I got out of college in the late 80s, this guy called Peter Lynch. Remember Peter Lynch managing the Magellan Fund? A big component of his investment strategy was non-financial data. He used these legendary stories about him going to the local shopping mall and watching teenage shopping patterns, which stores they're going in and out of, into the gap, out of the gap. And this non-financial data had a significant impact on his investment strategy. So if you put it in these simpler terms, that's all we're talking about. We get too, caught up in this ESG stuff. But unfortunately, material non-financial information is too long for the conference title, so maybe we should try that next time with subtitle, this thing called, also known as ESG. Michael, you're the only one on this panel that doesn't have like a focus on your LinkedIn profile that talks about sustainability and ESG and responsible investing, but you are the ETF guy here. You've got a long history in this. My question is more about, when's the first time you heard of this stuff? And how has that whole thing settled and evolved in your brain since the very first time you heard about this crazy thing called sustainability, ESG, responsible investing to today? Bring us through that journey.
Okay. So I'm Mike Venuto. I'm the co-founder and CIO of Tidal Financial. We help people launch and grow ETFs. There's about 80 ETFs on our platform, and $6.5 billion of that, because I checked before coming here, is about a dozen that are ESG and 3 that you might call anti-ESG. So the irony is that's about 700 million of our 6.2 billion, and only about 30 in the anti-ESG. So that kind of lends up to where you're coming from and how nobody raised their hand on the anti-ESG. So this ESG concept, though, it predates ETF, right? So it's kind of like, as we were talking, it was called something else, but it's this concept of sustainable investing of some sort has been around. People weren't really calling it that. I actually was with John Lekumnik this weekend. He's written a bunch of books on this, and he's one of the fathers of actually doing it before it was like something to do. He used to run the New York State Pension, and his vision is by investing this way, you're actually preventing wars and preventing things in the future that are allowing us to get better returns. Love the concept, but you could only prove it with a time machine, so it's not a great, easy counterfactual. From the ETF perspective, the second dumbest thing from standpoint was come up with the term smart beta. The first one was ESG, because that term, as it applies to ETFs, is just a disaster. So E, I would say like 90% of us can agree on E, or at least even if we don't agree, we can understand why somebody might do it, right? So that one's okay, we can go there. Then we have G, which I think everybody agrees on. Better governance, better company. There's not a single ETF that focuses solely on governance. So that's like the most obvious one. We have no products. We've had some, they've closed because apparently the most obvious thing people don't invest along. And then you have S. S is a giant disaster mess. And it really screws up the acronym, right? It's like, because everybody has a different S. There really isn't a universal S, right? So I have Adesina Social Justice on my platform. They have cohorts. They speak to their cohorts. They get data from their cohorts. They've raised money. Like, they're a tiny fund, but they were one of the most growing ones last year. That's very specific to their cohorts. They don't care about alcohol. They care about issues of employment and jails and things like that. I saw the VETS index out there. I bet you they don't have a problem with guns, right? I've seen the LGBT indexes. They have a very different point of view than the Sukuk funds and the Sharia funds that are on my platform, right? So the S is really, really, really hard, and I think it messes up this term. What we are seeing is, out of that 700 million of successful ETFs in this space on our platform, it's the ones that get very specific to their tribe and are very authentic to their tribe. And the broad-based ones, I think that's been commodified. I think, you know, the bigger firms have done it, the DWSs have done it for 5 bips, and I don't think that's where the money's flowing from a retail audience. I don't think the millennials that you guys are talking about are our clients at SoFi. They're not going in there and saying, I want the S&P minus 25 stocks that I don't know why we're getting rid of them. And then, oh, by the way, we're going to leave Pepsi and Coke as the top 2 positions because we care more about oil than diabetes. Like, so it's so many contradictions, it's insane.
That's the first time I've heard schizophrenic as the S, but anyway.
I think I can sort of respectfully disagree on a couple of points. So we can make it a little spicy for
You
the
told us to
afternoon.
make it spicy. So.
Yeah, no, I think that's good. I think one of the misconceptions in the ESG community, which does play into a lot of the ETFs out there, is around ESG scoring and kind of what that is and what it isn't. If you're not familiar with it, you might think it's similar to a credit rating. And so I hear quite a bit from pushback of saying, well, there's no correlation among ESG scoring providers out there, so that means it's garbage, right? Because how could you have credit ratings that everybody disagrees? And this goes into a little bit of social if people disagree. It's not really similar to a credit rating. It's much more similar to an analyst price target, where you're coming up, you have all this information that you're getting, and you're making judgments on what you think is material, and then how good that company is at those particular things. And people widely, pretty much disagree across the board on what is material, how to kind of balance all those things. And so the clients that I talk to find a lot of value opportunity in that. Trying to come up with your own sort of methodology for figuring out what is a value driver in the entire constellation of all ESG metrics out there. It is, I think, possibly where you can distinguish yourself and say this is kind of how we're evaluating it, and then this is why we are outperforming the market, because we have maybe a more dynamic sense of materiality. We can adjust our materiality based on what's happening in the market or something to that nature. So I'm sort of okay with disagreement in the market on what is valuable, but I think the answer to that is transparency. So like investors have to know what they're buying. If it is a no guns, that should be explicitly stated. They should know that they're investing in something that doesn't have guns in it. Or maybe they want guns, so they look for something else. I think there just has to be a bit more clarification in terms of do the investors know how ESG is defined in the investment that they're buying, and then does that match up with what they're trying to do? The other kind of anecdote I'll throw out there, just in terms of and I guess maybe you can answer this too, of the younger generation, if they want that ESG ETF or not. My former life was in structured products, and we had a couple we were trying to pitch some structured products linked to some of these newer ESG ETFs. And so we had 2 products that were essentially exactly the same. One was linked to S&P, and one was linked to the S&P ESG index. So same return profile, same risk, same fees, everything. The older generation wanted the non-ESG version, the younger wanted ESG. And the younger version was sort of like, wait, I can get ESG and it doesn't cost me anything? Like, why wouldn't I do that? And I think it's, again, how you're defining ESG. If it's sustainable returns, you're evaluating how companies are managing the risks that are material to them. That, to me, seems like good business sense.
So how many ESG ratings and scores are out there?
30 plus, maybe even more.
I'll argue there's well over 100.
Yeah.
And that's the thing. With every data company, mine included, we have a rating and a score. As long as you're transparent as to how you get there, it's not like a standard, like the 3 or 4 credit ratings that are out there. It's Wild West. You want to just?
Yeah, I was just going to add, I agree, but I'll come at it from a different perspective. And I think we've just demonstrated on this panel the challenge with the definitions. We're discussing S from a values perspective, and we're discussing S from a materiality perspective. So, I think, again, to your point about transparency, how is that asset manager defining ESG? Is it exclusions-based? Is it avoidance of certain things? Or is it looking at financially material factors within every pillar, including the S pillar? I would say, just going back to academic research, you know, we've certainly done some at Calvert, McKinsey, and others, have really demonstrated that the S pillar is incredibly important. Things like data security and consumer privacy practices for you know, credit card companies or computer companies, human capital management, diversity, equity, and inclusion. A company's ability to attract and retain top quality talent is critical, and is increasingly critical as more and more women and minorities get advanced degrees. If these companies of the future want to be productive, they have to create cultures where they're going to attract this talent and be able to keep this talent. So for us, we look at the S pillar, if you will, is incredibly important, incredibly material. And we also engage on these factors as well. We work with companies to try to help them improve in these areas, because it should lead to better performance as well.
So
I think the ghost doesn't like what she's saying.
No. This is in an effort to reduce our carbon footprint. We're going to dim the lights every 5 minutes. Leah, what's interesting, you know, new to this job, and I remember when I was starting my career, you know, I was always encouraged, make a list of everything you see that's wrong, and just keep writing and keep writing and keep writing, and hand that list in, because the longer you stay with that list, you get used to it. And it's not such a big problem anymore, and you get used to that. So from your early observations, you know, in this finance ESG life, you know, how are you seeing kind of the manifestation of this topic into the products that you're asked to analyze and create? And, you know, what types of products, what types of investors are you looking to cater to? Maybe you can just give some observations of what you see so far.
Yeah, no, thank you for the question. I think right now we're in a very precision technology era, so across different sectors. For example, in agriculture, a lot of what we're seeing is using satellite data to monitor land use changes, to monitor greenhouse gas emissions, things like that. The more precise we're getting with that, the better the data is, the better we can protect those resources and alternatively protect our water, better soil quality, more food production, so forth and so on. The same goes in the apparel industry. We're now seeing more biosynthetic technology being enabled here. We're seeing things like fermentation precision. So we're using yeast, incorporating that into clothing. We're also using fungi, banana peels, avocado shells, the list goes on, into clothing, and replacing that with traditional materials that are heavily emitting. And so a lot of investors across asset classes, banks, it could be really anything, they really just want to see the kind of innovative technologies all the way upstream. Are they changing their materials and inputs, and then using that innovative technology, incorporating that data into products? So that's lately what I've been seeing.
Have we driven anybody to a question yet? Oh, sorry. There you go.
Hi, Michael Scanlon, Silverleaf Partners, ESG, sort of heavy myself. And I think, and tell me what your comments are. I'd like your feedback that the Volkswagen diesel, tragedy, illegal use. I think 15 managers in Germany went to jail because of that. That was environmental, but it was really governance. So really, and Michael, to your point, like, who's really driving the car here? And E is easy. That train wreck in Ohio, environmental catastrophe of that township, right? But whose governance by the railroad company that was sort of lax to make this happen? Your comments would be appreciated. Thank you.
Sure, maybe I'll start. I think one comment that I heard earlier, and I hear a lot, is that governance has been agreed on and has been a thing forever, and it's not new, so why is it included? I think the key here is that the type of corporate governance that ESG tends to scrutinize has not been systematically included across the entire financial analysis. And ESG is not a predictor of fraud. So I think that's probably worth stating. This is not something that if you're an ESG investor, you're doing it because you think you're gonna have an early warning necessarily on fraud, because you're still accessing the same data that everybody else is. So if a corporation is lying, you're not picking that up, and I think that's one of those unfair critiques. But I think you can highlight where there are some governance considerations that should be paid attention to. I think regional banking is sort of interesting. Obviously that's a very hot topic right now. And an ESG kind of conversation around that I'm interested in is that should we really care what a regional bank is doing from an environmental perspective? Is that the ESG thing that we should be paying attention to? I don't really care, honestly, what they're doing. Their footprint it's not material to the landscape of what we're talking about, but I care a lot about their corporate governance and how are they managing their data security? What's their systemic risk management process look like? And that's sort of the ESG conversation around that. So I think when you're looking at these corporations that have these giant failures, often you can trace them to some ESG governance concerns. And I think that's where and also when you look at the why ESG has raised in popularity, I think it's not just because of the E, that was what I think people kind of think about. But a lot of it comes from the financial crisis. A lot of people said, what are these businesses doing with our money? How are they planning long term? Are they prioritizing long-term growth over short-term growth? And that's sustainable investing. So when you think about it that way, I think that is much more reasonable and hopefully less political. So if you're having those conversations, it's about long-term growth. I think that's what we're trying to achieve.
Lenore, anybody that talks ESG eventually gets dragged into more of the UN Global Compact principles and sustainability or sustainable goals. And each one of those goals has a different color, whether it's education, feeding people, water. So it's a whole rainbow of colors that represent these different strategic development goals. I bring that up because this term greenwashing, which somebody modified recently to rainbow washing, because all these strategic development goals. Any conversation about sustainability or ESG, wouldn't be finished without a conversation of greenwashing, which is where the SEC is looking as well in regulation. So maybe you can educate us in greenwashing.
Yeah, sure, I'd be happy to. So I think in the context of greenwashing, it can occur in two areas. It can occur at the company level, and it can occur at the asset management level as well. So I'll start at the company level. And talking about ESG data, a lot of the ESG data that's come to market, particularly over the course of the last decade, has been from companies themselves. They've been voluntarily issuing what are known as corporate sustainability reports, or CSRs for short, where basically they're describing essentially how they're managing their ESG capital. But unlike in the financial world, they don't have to disclose on what's financially material. It's not audited. So companies can basically say what they want in these reports. So that's where greenwashing can occur at the company level. So it's really important that when you're working with ESG data, that you don't just take at face value, or the data provider doesn't take at face value what the company is saying, that they actually go look and beyond. Like if they say we've got great diversity, equity, and inclusion practices, but then if you look at the fact that they have a lot of unwanted employee turnover or a lot of discrimination lawsuits or whatever, they're clearly not executing on what they're saying or purporting in those corporate sustainability reports. So that's greenwashing at the corporate level. The asset management level can occur in a variety of different ways. It can be basically overstating how they're using ESG information. And a very popular way to uncover greenwashing at the asset management level is to look at how asset managers are voting their proxies. This is public information. By law, asset managers have to disclose how they vote each of their proxies. And so what's happened in the last couple of years is that asset managers have come out and said things like climate risk is real or important or something that we should be paying attention to, or other ESG factors. But then when you look at when they had the opportunity to vote on a shareholder resolution in support of the things that they said were important to them, often there was a big disconnect between how proxies were voted and what was purported and being said. So as interest has really proliferated in the last couple of decades, what that's given rise to are more and more asset managers coming into this space and saying, oh yeah, we do ESG, but not really backing up those claims by really integrating ESG fully into the process and certainly not consistently voting their proxies in alignment with what they say is important to them. So that's what greenwashing is. And for financial advisors, especially those that are working with impact-minded investors that want their capital to make a difference, you want to make sure that you're aligning yourselves with those asset managers that are not considered greenwashers. And I'll just give a quick little shortcut to this whole thing. Back in December of 2020, Morningstar came out with an ESG commitment level report. It's very comprehensive, 90 pages or so in length, and it looks at everything that I've more or less described. How integrated is ESG into the process? Do these companies and do these asset managers engage? Even if they don't, do they vote their proxies in alignment? And certainly many other factors go in there. And they ranked global asset managers into 4 categories. Leader being top, advanced being second, third is basic, and fourth is low. So more or less take a look at that report, and it'll help guide you in the direction away from greenwashers and more towards those that are real leaders.
Think about what you just said, one moment. From the company itself that has to have more transparency into their ESG data and what they're like, to somebody evaluating it as an investment. Well, maybe it's a portfolio manager that wants to look at several different companies and include them in a portfolio. So now I've got this ESG data test for the company and then the portfolio of companies. Now I've got the asset management firm itself, and what happens if all the people that own that asset management firm are criminals or sex offenders? So I mean, how embedded this gets, and then the investor in the investment company, the pension funds. So I mean, it's ESG, there's this ESG data exposure in, all the way along the way. From the company underlying investment that people are investing in to the end asset owners and investors. Sorry, I cut you off, Meredith.
No, one thing I was just going to add on greenwashing, at least in the US, it's primarily a franchise risk. It's a risk, it's a reputation risk. There's actually very little regulatory framework to attack greenwashing in the US because of the way our regulatory system is set up. It's much more about investor protection and disclosure as opposed to being a sort of prescriptive nature regulation. So Europe is really undergoing a lot of efforts to sort of define what is green or define what is sustainable through a taxonomy. The US does not have that. So when we talk about greenwashing, it can kind of be confusing because you hear it and you would think, okay, well, the SEC is going after XYZ fund for greenwashing, and that's not entirely true. It's much more of a compliance violation that they're looking after. Are you doing what you say you're doing? That's almost it. So it can be a fairly low bar, but if you're putting out marketing, are you living up to that marketing and what you're doing? It's not, you said this was ESG, we don't think what you're doing is ESG, or you're doing green, but that's not really green. So that's a bit of sometimes a challenge in the U.S. market where we're not going towards a taxonomy. I don't see that coming. That's just not the way we run. And I think it also breeds a lot of flexibility, which hopefully can allow us to continue to innovate and come up with good ideas in this space.
So, Michael.
Yeah, I wanted to give the ETF perspective on this.
I was going to say, you speak ETF.
Yeah.
So, what's the trade?
Yeah,
Where do we
so
make
I have
money?
to deal with the SEC like every day talking about names. Because of what's happened with ESG, we now have a proposal for one of the dumbest pieces of legislation that will ever come out. And it's a naming conventions. And I doubt we're going to see too many more ETFs with the term ESG in the name because they've made the bar so high and so impossible to define anything that it's ridiculous. Hopefully it doesn't really happen. I don't know, Peter, are we going to get this thing or no? 50-50. Hopefully it's a zero because it's not helping investors. It will actually hurt investors. And they're already trying to impose a lot of the things in it even before the law has been passed.
But what about under the President DeSantis regime?
I'm not getting into the politics of it, but
This is my ESG dig.
Yeah.
So I don't actually mean any of this stuff. But
no, but I do want to hit on one other part of it real quick, though. So again, I think it is forcing more customization down to a specific issue,
Yes.
specific S's, specific G's. There used to be G's. There was an ETF flag that looked at forensic accounting, right? That's a G that made sense, and it's very easy for people to see. The other thing that I think is very interesting is proxies. I don't know if you guys saw the State Street announcement that they're going to look through and let people vote through. There's Say that was acquired by Robinhood, Tumelo. I was with Georgia and Will this week. Like, that to me is the most important part of this. Like, not owning a stock is not really moving the needle. Owning a stock and voting it to change things, that moves the needle.
And I would say that is actually, it can be kind of difficult in this political environment. I think it's probably not controversial to say, sometimes the loudest voices are not always the most informed on a topic. And so it can be kind of tough to sometimes understand what the argument is. I think one of the more cogent arguments is around voting and voting transparency, and the mandate that asset managers have if their assets are passive. You know, if I buy an S&P ETF, how much am I licensing that manager to vote on my behalf? Do they know what my corporate governance ideals are and what I think should happen? So especially because we've seen so much consolidation in the market, we have a couple outsized players who, if they make some of these decisions, can really push corporations in a direction. And I think that's where, I'm not going to say that's good or bad, but more transparency around that. I think passing it back to the investor is going to be really tough. I don't see how that that works. That sounds nice, but it's a very complicated. It would be very complicated to vote on every investor resolution in your portfolio. So I think there's a lot to be done in this space, but at the very least, transparency, and this topic, I think, is where there is quite a bit of meat in terms of a debate to be had.
Question? Please.
Good afternoon. This is Sandra Myberg. I run Fern Impact Partners, and we successfully navigated the markets last year in an ESG plus impact hedge fund and 3 long-only products that beautifully outperformed the markets. So the controversies around ESG is about the controversy scores. And the one thing that we typically say, if you purely look at an S&P ESG ETF, it is typically the biggest holdings of the technology names, and the controversy surrounding them are privacy and monopolistic practices and issues that plain ESG ETF is not picking up. So controversy scores or materiality type scores are incredibly important, and we are pushing big rating agencies such as Bloomberg and other groups to add that, because you cannot look at the E, S, and G in isolation. You have to add those controversy scores, and I say those scores are in its infancy. How quickly does board governance change? It's a very, very slow-moving parameter. So how do we incorporate that? How do we incorporate that kind of governance? And we, for instance, pick something up such as high debt-to-equity ratios. And of course, during the week of SVB collapse, we look at our portfolios, and I asked our CIO, would we have been invested in this? And the answer was definitely no, because of those high debt-to-equity ratios that directly points to the governance of a firm. And at the same time, we also look at insider trading, and 2 weeks before, they traded out. So there's other things that can point to it. I say we are at the beginning of an amazing opportunity to truly call big companies out for doing the right thing, not just to company, but also to people and planet.
Thank you very much for your comments. I've been told we are out of time. We want to thank you very much. If you do have questions, please come up and talk. Thank you.